Hi, I'm Michael Wagner, one of the co-founders here at Omnia Family Wealth. I'm joined today by Alon Ozer, Chief Investment Officer here at Omnia. Hey, Alon.
Hey, Michael.
So, what we've been doing is we've been having some conversations about our 2021 outlook. Today, we're really going to focus on what does the United States of America look like post-COVID, post-lockdown, post-vaccination? How does that translate to GDP? And does that ultimately translate into stock returns? So, again, Alon, thanks for joining us. Thanks for your time today.
Of course.
Um, what's going on right now? We've had this massive wave of vaccinations. You're starting to see lockdowns being lifted. What does that mean for the U.S. economy?
Well, it's great for the U.S. economy. It's great for the U.S. in general. We had such a trauma in 2020, and we're still recovering. That everybody is very happy to see us getting back. It's gonna be slow. It's gonna be gradual. It's not gonna be right away. But we're getting there. We follow other countries that started lifting their opening more, and one of them is Israel, for example. That's one of the first countries to do that. So we can follow them and kind of understand what they're doing and see if they make any mistakes and learn from that. But it's encouraging. There's still a lot to digest. It's been a pretty significant shock to the system, but we'll get over this.
Now, I'm wondering if like the sort of like patchwork of states that are open or locked down or anywhere in that spectrum between like pre-COVID and post-COVID, does that play into the overall economic growth? Are there concerns if certain states are not fully open while others are? Does that ultimately have a big impact on the big picture?
The Well, yes. So in order to get back to get the economy back on track, we really have to open and back to where we were. But we know it's gonna not gonna happen right away. It's gonna be gradual, and the question is what we can do in the meantime and learn from other countries. Um, but at the same time, something else happened, and this is something that while 2020 was horrific and were really bad. I mean, a lot of people suffered, some lost their lives. It's not an easy thing to digest. But at the same time, if you look on the bright side, what I saw is something that I was stunned. I saw Americans stepping up to the plate, helping others, becoming more innovative, becoming more fierce, not giving up, really fighting. And this is something that I think, you know what, if you have to look at the bright side, this is for me the bright side. We got a slap in the face, but we said, you know what, it's fine. We're waking up, but we're going to continue going forward. And you can see that in companies, in technologies, in almost any sector that you look at. And that's actually encouraging because this is the real America. This is what you would expect to see.
Sure. So is there a lag between like the real economy coming back and then when we start to see that in the data?
Yes, there is a lag. I mean, if you look at the S&P 500, for example, that's at all-time highs or more or less. It's something that that the market projects that the economy is gonna get back to where it was, and there is a certain lag. Now, some things can take longer than what we think, but investors should expect some um, some interruptions in the way of getting back to the normal life that they had before. It might not be exactly the same, might be close, but it's something that you need to take into consideration.
And no, that makes me think of another question, right? So what does back to normal mean anyways, right? And so what I'm thinking of is there's a qualitative answer to that, but there's also quantitatively. So I'm curious, like, yes, what does it feel like? But also when you're looking at the data, is there anything you're looking at specifically to see like, okay, if X gets back to Y, then we're back to normal, or then we're back to pre-pandemic levels?
Great, and that's a very important point because um, At this point, yes, we look at the data, but we also take into consideration that a lot of it is distorted. The Fed is very active in markets. The government is very active in stimulating the economy and giving people money to help them in this rough time. So when you see the numbers, it's not necessarily how it's going to be, because at some point when we're talking about normal and whatever it's going to look like, it's not going to be the same, right? The government is not going to keep injecting money into people's pockets. So we have to see what it looks like. So when you get back, how much hiring is there going to be? Are companies going to go back to full employment? Are they going to go into a different model than they used to? So there's still a lot of stuff that we have to understand how it's going to look like. But in general, the economy should do better. Now, it doesn't mean that the stock market is going to do better. They're separate things, but the economy has still time to recover, and we see that in other countries. We see the economy in other countries are doing better as they start lifting up and opening the economy.
You made an interesting comment that I want to circle back to in a little bit about how GDP is not necessarily S&P. But
Right.
before we get there, so I want to go down a little rabbit hole. Technology and how it's had an impact on our habits, and how some of those habits may go back to normal, but some of these new COVID era habits may stick with us. I'd love to hear your thoughts on what that may mean for really anything. I'll throw out some potential impacts on employment or miles driven and how we use our infrastructure, which may tie into stimulus and all sorts of other stuff. But I will present that with you and let you run with it.
Right. Yes, it's a massive topic, actually. So let's start from the infrastructure. So infrastructure, we know we haven't been investing in infrastructure for a long time, especially since the financial crisis, where we actually stopped investing in infrastructure, and that was a disaster. So we are gonna see a big bill of infrastructure coming into through the administration. It's not going to be enough. If we just think about our grid infrastructure, it needs hundreds of billions of dollars in order to bring it to where it's supposed to be. So that's something that's going to take a long time, but it's stimulus, and obviously we'll have to raise the money, and that's a whole different topic. But when you look at technologies in general, and what you mentioned, this is something that we're really, really, really excited about, because yes, technologies were before the COVID, and but they accelerated dramatically during COVID. We see companies do things that we haven't seen in many, many years. And we hear that from many CEOs of companies, where they talk about a new era in technology. We haven't heard them saying that in ever, basically. So that's really encouraging, and we see that, and it's yes, it goes back to the new models that companies are trying to adopt. But if it's electric vehicles, if it's clean energy, if it's SaaS technologies, if it's whatever it is, wherever it is, you see dramatic improvements in technology and efficiency, especially in efficiency. So this is something that's going to affect our society in a good way. It's deflationary by nature, so that's something that's actually going to help us if we start seeing some inflation. And this is one of the things that it's one of those things where you really need to have it in your portfolio. I'm not saying it's easy to do or target the right companies, the right sectors, but this is something that you need to have in a portfolio.
Sure. No, thank you for that. Okay, so let's go back to that thing that you mentioned about S&P and GDP. We always hear that the stock market is a forward-looking sort of predictor of the future, for lack of a better term. What is going on in U.S. equities today? Because I do think it's fair to expect very positive GDP numbers coming off of last year. How does that play into capital market assumptions, what's going on in stocks today and what we think may be going on in stocks in the next, let's say, 12 to 18 months.
Right. So this we have to remember. This is not a normal year. Last year was definitely not a normal year. What happened is that the minute COVID hit, the government stepped in to bridge the gap of falling consumption, falling earnings. So at some point, they would have to also get out of the way and let the economy recover by itself. But in the meantime, we need to see that business are really coming back to where they were before. So it's gonna take time. In the meantime, the market is doing very well. A lot of it has to do with the stimulus. A lot of it has to do with lower interest rates. Valuations are not cheap. It's actually, we think it's a little bit too much, ran too quick, too far. But it doesn't mean that the market is gonna reverse and fall. So in terms of investments, it's you still need to have your allocation to U.S. equities. You might want to find a way to generate the equity returns with not only U.S. equities, but do it from different areas, different channels, and not take that risk, because in the U.S. the market is very sensitive at this point to interest rates, and we don't know yet what's going to happen. Not the Fed interest rates, but yields in the market. So we have to wait and see and be very careful. But overall, you should see better GDP prints going forward.
And so I guess the question then is, does a very good GDP print necessarily mean that we're going to have a huge rally in equities?
So no, not necessarily. Also, just like you mentioned, the market is forward looking. So if you have the good GDP print now, it means the market already took that into consideration. So it's not going to be affected by that. So if it expects another good GDP print, then yes, maybe it's going to keep going higher. But markets are complicated. They're not rallying or falling based on one indicator if it's only GDP. So it's very hard to say. The most important thing right now to focus on is interest rates. That's what's gonna determine what I think in the intermediate term what's gonna happen with equity markets. So that's the critical point to look at. Overall, the economy was in such a bad place that it should print a couple of quarters at least of positive good GDP. But it's not necessarily going to translate into higher equity prices. It
Sure.
could, but not necessarily.
And to circle back on a comment you made, you mentioned that people should potentially be looking at getting their equity returns from other markets. What did you mean by that? Is that international equities? Are there other non-equity asset classes that can give you equity-like returns?
Right, correct. So in the US, you can diversify yourself within the US market, which is something it's it's probably a good idea to do. International markets, what they offer you is a couple of things. Is first, faster growth, so faster GDP, faster growth of earnings of companies. The other thing is they offer you the diversification of the currency, because this is something that we're going to talk about for a long time. Is the US dollar and the ability to really stimulate the economy, generate a lot of stimulus, basically printing without hurting the dollar massively. So this is something that we're going to be talking about. But it's important to diversify. So if you can have your allocation to equity diversified with some international markets, international companies that have really bright future, better valuations, and a stable currency, that might be very beneficial for your portfolio long term.
It's interesting. Is there anything, based on the conversation we're having right now, that you see going on? It could be the U.S. equity market, it could be global equities, that concerns you, that gives you pause, or may lead you to think that, maybe trees don't grow to the sky?
Yes. Yes. The main concern that we have right now is with U.S. equities. So U.S. equities, there's a lot of money coming in here, so that's great for equities. But we think valuations are a little bit stretched. But what we are mostly concerned about is what the Fed is targeting and what's going to happen. So the Fed is targeting inflation. If it does come up, they'll have to raise interest rate, at least start by just stopping their purchases of bonds in the market. If that causes yields to go higher, we think that's going to affect the market significantly. And we've seen it in the last quarter of 2018 when this whole new environment came into place. So that's a concern that we have, and we have to watch that very carefully. If that's going to happen, then U.S. equities might be in jeopardy here. On the other hand, we look at other countries where, especially emerging markets, that did not use stimulus in the COVID during COVID, and this is something that they still have the dry powder to push their markets, and they're doing better. They have better growth. They have lower valuations, high risk, yes, higher volatility. But when you look at long term, and if you can really manage your risk at a portfolio level, this is something that you really should consider. So again, going back to diversifying your equity allocations, the U.S. is the greatest country, but it's not always going to be the best market.
No, and I'll add that it's also sizing those allocations appropriately. Where you have higher risk, having less size, having a less large allocation to that specific sector.
Right, and that's the most important point.
Yeah. And though it sounds like our concerns about any that we may have about U.S. and U.S. equities are more temporary, would you say that long term we're still very bullish on America? And
we're very bullish on America. There's no doubt. We have concerns about the monetary policy, obviously, like a lot of other investors have, trying to figure out where we are in the grant cycle and how it's going to affect the equity market, how it's going to affect the fixed income market. But if we go back to technology, for example, this is the leading country in everything that they do. So this is very bullish. You're going to have cycles. You're going to have markets that are falling another 30%, fixed income market that's not doing well. That's part of it. But that's part of building a stable, robust portfolio. That you have to take all these things into consideration. Looking long term, you can be better, I would say more comfortable building portfolio with U.S. equities, because long term we think America is definitely going to do better.
Sure. Well, Alon, again, thank you as always. I thought this was a great conversation. The idea here again is to be mindful of where we're at in that large grand cycle that Alon refers to. We are very bullish and very happy to see the country and the world turning a corner on this terrible pandemic. We are looking forward to the future. We're very optimistic about that. We do feel there are some concerns when it comes to where we're at, when it comes to valuations in equities, valuations on bonds. We're keeping an eye on where we're at with inflation. We encourage you to do the same. Always be mindful of your sources. Thank you for spending your time with us today. Alon, thank you.
Thank you.
And that's all we've got today. Thank you so much, and be well.